From an overarching area, we think that structured credit can offer a lot of opportunities through the cycle. So we're actually quite positive on what structured credit can offer. We think kind of diversified portfolios that you build within the structured credit investing space means that there are more insulations from some of the key risks that you've been highlighting through this morning.
So you're saying trade wars and all that narrative does not impact your world at all?
It does impact us, but the effects are perhaps more broadly spread out. So the portfolios are diversified generally by sector, by geography, and so individual sectors may be winners and losers when it comes to the trade wars. Actually, how the trade wars pan out is something that we'll realise over the quarters. The tit-for-tat retaliation that we're seeing at the moment is really trying to push and almost bully China into reforming, being a cheaper option than having the tariffs. But I think an interesting thing from a trade war perspective, perhaps, is that although the axis by which the trade war is being fought out is the US and China, that probably have an inflationary aspect into the US. Perhaps the effects in Europe are slightly more nuanced. There are potentials that the excess capacity arising out of China might reduce cost burdens and increase margins in the corporate sector in Europe. But saying that, we have all the overarching problems of disrupted supply chains and inflationary aspects coming out of the US.
The CLO market's been in a sweet spot, let's face it. I mean, you've had record volumes for 2016 and then 2017. Here we are in 2018, and Donald Trump is bringing us some volatility in the macroeconomic environment. That's not necessarily a positive story when it comes to the anxiety that may be felt by some who are watching for credit quality to deteriorate potentially. Is 2018 still going to be a record year, or might in the second half, might we see some caution enter the market as people begin to factor in some of these existential risks?
Yeah, the credit markets are generally forward-looking. I think if you look at where the US is in both its business cycle and in its credit cycle, it is in an extended cycle and towards the later end of it. So we're seeing more later cycle trends in US credit markets. Leverage has been increasing. And because of the rate rising environment, the tightening aspects, we also think that borrowers will come under increasing pressure. If you flip that over to where we are in Europe, we think although the growth is lower by percentage points in Europe, we think the credit underwriting standards have been more robust over a number of quarters. And so, for example, high yield net leverage is down towards lows in Europe that we saw in 2005. So we think there are quarters, even years, several years of the credit cycle in Europe to play out. If you layer on top of that the ECB, our view is that the ECB has announced its path, but it is data dependent, and it does have a narrow mandate, which is inflation linked. And so if we are to see any weakness in that, then there will be additional support from the ECB into the European markets, which will hopefully keep credit investing in its sweet spot, as you mentioned at the start.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now, to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.